Want to buy a home in Canada but struggling to save a massive 20% down payment? You don't actually need it. Today, I am breaking down two completely different ways you can get into the market with just 5% down, including the hidden pros, cons, and a major pro tip that most buyers completely miss. The first and most common path is the traditional route through the CMHC insurance program. The big advantage here is that you only need to put 5% down payment cash upfront to get the keys to your home. However, the catch is that because your down payment is low, you have to pay an extra insurance premium, which is usually around 3%. This 3% is tacked right on top of your mortgage balance. The good news is that these extra insurance costs will be lifted after you build 20% equity in your home. The second option is gaining huge popularity in the Canadian market right now, and that is finding an investor partner to top up the remaining 15%. There are many companies currently doing this in Canada to help you reach a full 20% down payment. The formula for this partnership is usually based on a 5 times return on whatever percentage they invest. For example, if they participate 10%, which is exactly half of the required 20% down payment, they will expect half of the future profit as well, meaning 50% of the profit. But the great point here is that if you don't sell the house with any profit, you don't pay them any profit. If you buy a home for $1 million and 10 years later you sell it for the exact same $1 million, you won't pay any profit at all. You just pay back the exact same money they initially invested. But if you sell that $1 million house for $1,100,000, you will have to pay $50,000 of that $100,000 profit to your partner. Now, here is a massive pro tip if you go this investment route. You do not have to pay any monthly installments or any interest to the investor while you live there, and you have up to 30 years to sell the house. This is going to save you not only the 3% extra CMHC insurance fee, but you also don't pay any monthly interest or installments for the portion that is being invested by them. Keep in mind, you still have to qualify for and pay your regular mortgage every single month. But check this out. When it is time to calculate their profit at the end, they are going to give you back 100% of the principal you paid down on your mortgage. This means you do not share any part of the equity that comes from your own hard-earned monthly mortgage payments. You only share the value of the house that came from market appreciation. Of course, there are legal protections and rules you need to know. Currently, the title of the house is entirely under your name, but the investor will put a lien on your house. This ensures that whenever you want to sell the property, the investor will automatically be aware. Another important con to consider is that you cannot get a HELOC or home equity line of credit without their explicit approval, and you cannot use a HELOC to buy out their share. If you don't want to sell the house but want to buy out the investor early, you have that option. However, they would expect at least a 6% annual interest rate on their money or the actual appraisal appreciation percentage. Whichever of those two numbers is higher is the one they will go with. But on the positive side, because it is their own investment on the line and they are fully willing to protect their investment, these companies will actually give you free, ongoing consultations on home maintenance to make sure your property stays in top shape and keeps growing in value. So, which strategy sounds better for your situation? Would you rather pay the CMHC premium or partner up with an investor? Drop a comment below with your thoughts, and don't forget to like and subscribe for more Canadian real estate and mortgage strategies.